Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Jarrod Kerr, who's the Chief Economist at Kiwibank. You may have recently seen the top 10 that Jarrod wrote for us on the top 10 risks for the New Zealand economy. Thanks for joining us, Jarrod. Great to have you here. One thing I thought would be interesting to kick off with, you've done a lot of work over the years around the bond markets, and that's a fascinating beast at any time, any given time. The world of interest rates is very interesting at the moment. We've obviously had New Zealand bond yields and swap yields below those of the US and Australia, fluctuating around a bit, but this is a pretty unusual situation. So I guess if we just kick off and sort of say, what does that actually mean, and what could it mean in the future, I guess, for the average person in New Zealand if this sort of scenario continues?
Well, firstly, the US is growing at a reasonable clip, and their labour market's tightening, and it looks like they've kicked a lot of goals in this recovery. So they're in a position where they're tightening policy now. So they've gone from a zero interest rate to 2% now, getting close to, and the Fed's telling us they want to tighten another 2 times this year. So we'll have a cash rate in the States which is 50 to 70 basis points above the cash rate here, and that's the first time in a very long time, and I think it will last for at least another 2 years. So when you look at a bond market, you start off with a cash rate, and then you work out where interest rates are going to be over time, and their 10-year rate is close to 3%, whereas ours is a little bit below that. So our entire interest rate curve is below the US, and that's a first. What that meant historically is that the currency should fall versus the US, so the Kiwi should come off. But this time round it's not quite the same. We have a terms of trade which is at record highs, so that's putting upward pressure on the currency at the same time where interest rate differentials, so a US rate versus a Kiwi rate, is negative and putting downside pressure on a currency. If the terms of trade was to come off, so import prices were to rise or export prices were to come off, then I think we'll see the Kiwi dollar depreciate a little more in the next year, and that's kind of what we're forecasting. We think the Kiwi will drop to 67 next year. Not a big move, but we think it's the right move.
Interesting. And in terms of, I guess, where the rubber hits the road for borrowers in New Zealand and I guess savers, I mean, mortgage rates, deposit rates, what impact do you see what's going on internationally having on those in New Zealand in the next year or two?
Well, the good news is that global growth is stronger. Inflation looks like it's going to rise in the next few years, so that gets put into an interest rate. So if global interest rates are rising, and the ECB last night said that they're going to stop printing money by the end of the year, so they'll stop holding down European yields. It means global interest rates will continue to rise from here, and that gets put back into our interest rate market. But the key here is when the RBNZ's comfortable enough to start normalising policy, and we think that'll be around the middle of next year. So our forecasts are that the 2-year swap rate, which is key in New Zealand, will do nothing for the next 3 or 4 months. But then into 2019, we'll see that rate move higher. So if you think a 2-year swap rate is used as a hedge for banks to offer a 2-year mortgage rate, then that's going to rise next year as the RBNZ lifts off, as global interest rates rise. But on the other side, deposit rates will lift as well. So savers will be getting a bit more for their savings, but borrowers will be paying a bit more on their loans.
In terms of the RBNZ, so we've got the OCR at 1.75 now. US is now above us for, I think, the first time ever, or certainly the first time in a long time. Where do you see that OCR going in New Zealand? I mean, you talk about the RBNZ, looking to normalise policy. What is normal policy in 2018, 2019, 2020? What does it look like?
Well, it looks nothing like it did 10 years ago. We know that much. And you don't really know what normal is until you've gone past it. So we think it's around 3, we think, or it might be higher. might be 3.5. You don't know until you get there. Things have changed in the post-crisis world, but at 175 we know it's accommodative, so we know that they can do 100 basis points, take it up to 275, and we don't think the economy will collapse. But it will be a very slow process getting there. You don't want to get there in a couple of meetings and cause damage. It will be a very slow process. We think the RBNZ will be in a position where they can raise rates in the middle of next year. So we can see our cash rate going to 2%, say in August, and then maybe one more by the end of next year. We don't think that will spook anyone. It's priced in the market. And then a very slow push towards 3%. But we think the Fed will get there first. So we will remain sort of below them for a while, which is good. It will keep the pressure off our currency.
Now, you recently put out a report on the New Zealand economy, and as I mentioned, you did a really great top 10 on the risks to the New Zealand economy. Well, obviously, we live in a really uncertain world. We've had extraordinary events this week with the G7 meeting, the Trump Kim Jong-un meeting, which is very much unheralded. So, I mean, where do you see the New Zealand economy going over the next couple of years, and to what extent are we hostage to some of these global events?
We're always hostage to global events. We're a very small, open economy, so is Australia, and big movements in financial markets or economies overseas filters down here and impacts us. So when global growth looks good, we look good. At the moment, global growth looks good, so we look good. We're predicting that the New Zealand economy will go from around 3% to 3.5% next year. Government stimulus is helping that, but also, you know, the better global backdrop. But at any given time, there are quite a few risks, and most of them are foreign. As you said, you know, the G7 last weekend, Trump. All of this is coming about by a wave of populism. So people who have been disappointed with their outcomes, you know, particularly their income over the last 10 years, are voting for change for the sake of change, or change to make themselves better off. The US voted in Trump as an anti-immigration vote. You know, the UK voted Brexit again as an anti-immigration vote, and we're seeing that sort of you know, that frustration playing out around the globe. So right here, right now, we're worried that we'll see a continued increase in trade restrictions or trade war. We're nowhere near that full-blown war today, but you know, there's a bit of fuel there that can easily ignite and can escalate quite quickly. That will damage Australia and New Zealand because we are heavily export reliant. Our largest trading partner is China, so any war that China's involved in may hurt us. But we're plugged into an Asian economy which has grown really well and has a middle class which is growing, and that's the important bit for us. As their incomes grow, they buy more stuff out of New Zealand. So I think we're okay, and the tariffs that have been talked about are basically a rounding error in terms of global growth, but it could escalate.
Now, you touched on one of the factors that's talked about a lot these days, which is wage growth or lack of. What is your outlook in New Zealand for that?
We think wages are going to rise. We think the stars are aligned in our labour market. We've seen the unemployment rate fall. We've seen the labour market tighten. You know, our customers, our business customers, are coming to us telling us it's hard to find the right labour. And then you have quite a substantial increase in the minimum wage coming through over the next 4 years. So you've got an economy which is bumping up against capacity constraints, particularly in construction and tourism and some other areas. The way you attract people into a labour market is to increase the money, and we think that'll come through. But then again, on the other side of that, the employers that have to pay that bill are worried about their ability to pass on those costs or have to wear them with reduced profitability. So it's we think wages are on the rise after years of really disappointing growth, but it might also slow us down.
Look, thanks a lot for that, Jarrod. That's Jarrod Kerr, who's the Chief Economist at Kiwibank, and I'm Gareth Vaughan at interest.co.nz.